Okay. All right, thank you all for coming. Thanks, Terry. It's great to be back in El Paso County. Actually, it was really nice. I think we set a record temperature yesterday, and I was talking with El Paso County Commissioner and Chairman of the El Paso County Board of Commissioners, Daryl Glenn, and he had a couple of comments that he wanted to make about the weather. So I'm having a little fun with Daryl, who's also a good friend. And so I want to welcome and thank you to El Paso County Commissioner, and let's welcome Commissioner Daryl Glenn.
My brother.
All right. There you go.
Dilly dilly. I am not standing behind the podium because you probably will not see me. When I first walked in here, I thought I was in church. I never see all the back rows fill up so fast. You can see there's nobody here. But the first order of business before I give you the official welcome is, yesterday it was 70 degrees. And now look at the weather outside. To me, I think it's all Lou Gator's fault. So for everything that goes wrong during the conference and for the weather, all those in favor of blaming it on Lou Gator, say aye. Aye. Any opposed? It carries. Thank you, Lou Gator. Dilly dilly. I want to thank everybody for coming here. I understand we've got a pretty aggressive agenda today, but El Paso County is really turning around. I've been around, whether on city council and now as a county commissioner, for a while. And gone are those days when we were here and we were still struggling with the economic recovery. I mean, if you think back, we were shutting down street lights. We were not being able to put plants in the median. And now what you're seeing is a new relationship between the elected leaders and our community again. And we have the opportunity now to start making some investments. So when you're driving around, you might see a lot of cone zones around because people are starting to actually, we're doing some repairs to our streets. We just recently had a table retention question on the ballot, so we're able to really address those particular issues that are critical to our community. But I think collectively we can all agree that we must continue to work together and unite to come up with a critical plan on addressing our transportation problems in this state. We've got to come together and start focusing in on infrastructure. That's a message that came across loud and clear. So on behalf of the Board of County Commissioners and my fellow commissioners, Commissioner Mark Waller, Stan Vanderwerth, Peggy Littleton, and Lojinos Gonzalez, we want to welcome you to this community. Please take an opportunity, if the weather permits, to go out and enjoy what's going on. We're starting construction on a one-in-a-lifetime Olympic Museum. But again, thank you, and it is truly an honor. And if anything goes wrong, call Lou Gator.
Thanks, Daryl. What is that they say with friends like that? Thanks also to the El Paso County Commissioners. I want to take a minute and give a shout out to our conference sponsors, with special thanks to our platinum sponsors, Wagner Equipment, and they'll speak tonight at the President's Reception in Anadarko, represented by Chantel Taylor, and I'm sorry if I get your names wrong here, Kimberly Mendoza-Cook, and Elizabeth Smith. Those weren't too hard. I think I did all right on those. Barbara's she's on her head. I got them all right. Okay, good. I had a chance to get to meet a couple of them today. And then also Nationwide Retirement Solutions, and by our special friend, Bert Burrows. Bert, are you in the room here? There he is in the back. Everybody say hi, Bert. All right. In addition, our gold sponsors are Comcast and CTSI, the sponsors of this morning's breakfast. And thank you again to all of our CCI sponsors. And then as we develop our program, take a breath, Lou. Change subjects here. As we developed our program, our conference program to address the theme, Funding Your County's Future, became quickly apparent to us that the financial health of our counties depends in large part on the health of the economy. And not just the local economy, but all the macroeconomic factors and trends that currently influence or may influence our county economies in the future. So to give us the best possible information and insight, we turn to Dr. Rich Wobbelkin to present what's ahead for the Colorado economy. Why don't you start coming on up, Rich? And I'm going to start reading. This bio takes like 20 minutes, so you can walk slow. Dr. Wobbelkin is Executive Director of the Business Research Division and Senior Associate Dean for Academic Programs at the University of Colorado Boulder. We won't hold that against you. I'm a CSU Ram. What can I say? A little bit of friendly in-state rivalry here. He joined the faculty at the Leeds School of Business in 1985 and has served as Associate Dean since 2000. As Executive Director of the Business Research Division, his responsibilities include developing an annual consensus forecast of the Colorado economy and performing various economic impact assessments of the Colorado economy. That's a mouthful. You do a lot. It's pretty cool. Rich is also a member of the Governor's Revenue Estimating Advisory Committee, the Denver Regional Council of Governments Forecast 2035 Advisory Committee, the Colorado Tourism Office Education and Research Committee, the Boulder Urban Renewal Authority, and the Boulder Economic Council. And I'm told that Sally Clark, who is now part of the federal administration, hi Sally back there, is trying to get him in the presidential economic forecast as well. I just made that last one up, but it still sounds probably. Rich received his BA in economics from Bucknell University and an MA and PhD in economics from the University of Colorado at Boulder. So I ask that you please give your undivided attention and a very warm CCI welcome to Dr. Rich Wobbelkin. Welcome.
Yeah. So, as I always do, I tailored this for a little bit longer time. So I'm going to hit the first part of this sort of pretty quickly. I did want to mention a couple of things, that we produce a lot of information out of our office that's available electronically. We do, for those of you who are not familiar with the Business Research Division, it's been around since 1916 in the business school at CU-Boulder. And we have been doing a forecast of the Colorado economy. This is the 53rd annual forecast of the Colorado economy coming up. It will be released in 2 weeks. The thing that we believe is very unique about our forecast is we do every sector of the economy, and in doing that, we really cover the state economy. So we do a whole section on agriculture and a whole section on natural resources, section on tourism, and so on and so forth. We do work statewide, and so some of you have seen me or my colleague in the last year. We did a resiliency study, and we were in exclusively rural counties in the state of Colorado over the past year, including Otero is part of where we were. So just a little bit of background there. If you'd like to get any of our information, we do, I mentioned other things, but we do a quarterly newsletter, and it's coming up, and it's going to be focused on the western slope. We did that about 3 years ago, but we've done the southern part of the state. We did the eastern plains. So we move around on our newsletter to really focus on different parts of the state, not just the Front Range, which those of you, since there's so many sort of rural counties represented, you know the Front Range gets a lot of airtime. So we're trying to balance some of that airtime and understand the state. I also feel really strongly that you may not feel this way, but we're kindred spirits in a lot of ways. I have a couple of groups that I speak to on a regular basis: CCCMA, City and County, Colorado City and County Managers Association, and Economic Developers Council of Colorado. And I always feel when I'm in the room with those people and talking to those people like we're all on the same page. We all care about the state. We care about the rural parts of the state. We care about the urban parts of the state. And we care about things like infrastructure, which you heard just a couple of moments ago, which I think is going to be absolutely critical for the state going forward. So with that, let me hit the, to try to keep close to on schedule. I guess I got to hope the governor, oh, by the way, I'm not the governor, just in case you didn't realize that shot in the thing was not the governor. That's a long story that I don't have enough time for right now, but Gil Asakawa, the award-winning, Pulitzer Prize-winning photographer of the Rocky Mountain News. When Rocky Mountain News went belly up, he works for us at CU, and he insisted, he goes, oh, you need this shot. And so he took that shot, and whatever reason, it's caught on fire, so it's everywhere. It's like, to me, it's just a huge head, you know, it's just like, but anyway. So just again, in terms of national context, let me start off with a little bit on the national context. We do see GDP growth being a little stronger in 2018. This is a good thing. We're not seeing any sort of, probability of recession is 25% or less. So I know a lot of you have budgeting issues you have to think about and so on. We're thinking end of 19 or beginning of 20 is the first sort of, we see potential a little bit of slowdown in the economy. So we see the economy, maybe 2.4%. Again, some of this will depend on which tax proposal ultimately gets passed, how much of that gets spent by corporations or by individuals. So it's sort of putting that in a little bit of context. But what we do need to sort of notice or focus on is that the long-term trend has been down. Part of this is based on productivity, but part of this is based on the aging in the economy. And it's going to be difficult to sort of change that trend too much. I think some of the president's proposals could bump it up a little bit, but I don't think you're going to see this thing sort of dramatically change and go the other direction. Just based on sort of the tax policies that are out there, you're fighting again this demographic trend. So a couple people last night said, don't bum out my commissioners. So I'm hoping I'm not bumming out the commissioners right now. So, don't be depressing, So, well, you don't know, but you probably do know, there's a very famous economist who lives in Colorado Springs. She used to be out there all the time. She's sort of gone into semi-retirement or retirement. Her name is Tucker Hart Adams. And Tucker and I used to speak together 15 years ago, 20 years ago. We spoke together somewhat regularly on programs, at least a couple of times a year. And the headline in the newspaper was, two economists disagree on something or other. And they called her the Duchess of Doom, and they called me Rosie Rich. So, so for the commissioners, I'm the rosy guy, okay? Okay. So in terms of economic growth, again, background components, for the last several years, we've been really relying on the consumer. You've seen this in state data, but certainly at the national data. Government spending has been very weak, state and local and national. That has not really been helping GDP very much. Business investment has not been particularly strong, and net exports, of course, have been sort of detracting from growth because we have a trade deficit. So really, the consumer was, the responsible party, if you will, the last 5 years or so for really keeping the economy in this expansion. The great news is this year we have seen a jump up in business fixed investment. You see it down there in the left-hand corner. And that jump up is really helping the economy grow at a more rapid rate, 3% for the last 2 quarters. And we think that's going to carry on into 2018. Certainly some of the tax proposals could even make that better. So we'll see, again, not knowing what the ultimate tax proposal is going to be, or we'll wait for a definitive sort of statement on that. We look at employment growth. Again, we see that we peaked back in about 15 in terms of numbers of people joining the labor force per month. You can also, of course, see the travesty of the recession, the depth of the recession. But really, this is a signal of sort of running out of workforce at this particular point in time. And we're getting down to the numbers that look like full employment at the national level. We're certainly at numbers that look like full employment at the state level. So you've got this sort of combination of factors going on that's really keeping at least employment growth at a slower pace. But things could be worse. You're in Colorado, and we've been a top 10 growth state year in, year out since the recovery began. You see that in this particular slide, we're not in the darkest color. There are other states that are outperforming us, Utah, Texas, Oregon, and Washington in particular. But you will see a slide at the end, a summary slide at the end with a lot of rankings, if you will. And you'll just see how strong Colorado's been. So we've been a really good state. And by the way, you might want to notice the red, which is negative to the north, and the orange, which is negative to the east. So we have 2 states that are really struggling kind of big time year over year in terms of employment, and they are on our borders and bordering some of your counties clearly. So I mentioned the unemployment piece. So The number that we typically talk about is this tan line at the bottom. It's called U3 unemployment, nationally at 4.1%, clearly what we would call a full employment number. There's been a lot more focus. It came up in the election and the debates between Clinton and President Trump, now President Trump, and they debated back and forth about, well, should we even use the U3 or should we be focused on this other number, the U6 number? The U6 number includes people who are underemployed, would like to work more hours, those types of things. But even that number is down to sort of almost an all-time low at 7.9%. So we really don't have a lot of surplus in the labor force, and this is a big issue, again, nationally and in Colorado. So when you look at the picture going forward from here, a big part of this is labor force participation. And I think my friend Elizabeth Garner talked to you about this last year, those of you who were here last year, the state demographer. But one of the things that's going on nationally and in Colorado is that we don't have the same labor force participation in the different age cohorts in the economy. You can see on this particular graphic the peak year for participation for the various age brackets, and then the red is what we're at in 2017. So you can see essentially we're at the peak for 55 to 64. We're at the peak. We're setting the new records for 65 and above people staying in the workforce, but those numbers are dramatically lower than the other numbers, the 54-year-olds and younger. And those are people 25 to 54, the second, third, and fourth bar on this particular graphic. We call that the prime working age population. And you can see all of those are below their previous peak. Up until, since about 1970, we've had a declining participation amongst males in the economy, but starting around 2000, female labor force participation started dropping as well. And then we've also got this mystery thing going on with 20 to 24-year-olds and 25 to 34-year-olds. Why aren't these people, participating at higher levels? What are they doing? And by the way, this is not people staying in school, because if you're in school, you're considered institutionalized. So you don't count in the data, so the participation is not fully counted there. My answer to this, and I know some of you have heard me say this before, is like, it's because they're sleeping on your couch. So you have a role in this. When your kids say, Mom, Dad, can I stay in the basement? Okay, if you really love them and you think that's a good thing, you can have them in your basement. But when they say, do I really need to get a job? The answer is yes, okay? They need to get a job. They need to help us out here. We need more people. What you also see with labor force participation is a very strong correlation between the unemployment rate and the level of participation, but also the level of education. And this is sort of the standard slide that just basically tells you we need people to finish high school and we need people to get some additional training or an associate's degree or beyond. We have tons of capabilities and needs for people in the trades. This is not a pitch for everybody to go to CU-Boulder or CSU or UCCS here locally. This is a pitch to have people be more educated, more skilled. The opportunities are there, and the workforce needs are dramatic right now. We can't even come close to fill our construction jobs in the state right now, as an example. So we really need people to have a little bit higher level skill set, to work with the technologies that are out there, even in the trades. It's much more technologically sophisticated than it used to be, and this is going to help the overall picture. And we also believe or hope that in that process will help the wage growth. This had been sort of stagnating, and now we're starting to see a little bit of pickup in wage growth. And I'm pleased to say in Colorado that number is over 3%. So given our cost of living and given some of the other things in Colorado, a little bit stronger wage growth is warranted and probably, frankly, needed, just given the cost of living in our state overall. So when it comes to personal income growth, Colorado's changed 4.9% second quarter over second quarter, the most recent data we have. Again, a little bit darker tan. Some states a little bit better, but we're still the 7th fastest year over year, 13th fastest over quarter over quarter. And again, these are signs of us being, a little bit stronger economy, but also some of that getting reflected with our tight labor market. That we're starting to see some wage appreciation as well. So with that as background, a few comments about, a few more macro comments. Of course, income and consumption are huge. They're huge at the county level and at the state level in Colorado, and certainly nationally. They drive a tremendous amount of revenue in terms of retail sales taxes, and also income taxes in terms of in terms of earning income. So these are very important sorts of numbers that we pay a lot of attention to. And again, as I mentioned to you earlier, for about 5 years now, we see the consumption on the right-hand side really driving the U.S. economy. That's been fueled by having disposable income numbers that have been okay, at least. Again, disposable is after adjusted for inflation, so it's real after-tax income adjusted for inflation. So that's enough to keep the consumption going. But it's also, quite honestly, been fueled by the tremendous run-up in real estate and other asset prices, all sorts of financial assets that you're well aware of. And you can see after having that dip back in 2008, we've had this incredible run-up in household wealth. I participate in several things that are not on that sheet. It seems like everything is on the sheet that Lou read. But I'm on the oversight committee for the National Association for Business Economists on the macro forecast. And we just went through an exercise. We're coming out with a forecast next week at the national level. And we're going to be talking a little bit in that particular release about what would it mean to have a 10% stock price correction. And we think it would probably knock 2 or 3 tenths off of GDP if we were to see a 10% correction in the stock market. And that's one of those things that it's going to happen sooner or later. I don't want to be negative, but it's going to happen sooner or later. We've had this incredible run up. Sooner or later, you're going to get a little bit of an adjustment, and that's going to be probably actually healthy over the long run. The other thing we see with low interest rates is tremendously low cost of carrying debt. So we've had income growth, we've had wealth growth, we have a very low cost of debt, carrying debt, and in the process of doing that, households are still in a very good position to continue to purchase if they wish to. So they have all this ability, income, wealth, low interest rate environment, and dropped on top of that, the willingness to consume is reflected by consumer confidence. And we've seen a very strong and steady upward movement in consumer confidence, a lot of that being influenced by very, very low unemployment rates, high feelings of job security in terms of survey respondents. So all of that points to people buying more. And we think we'll see vehicle sales continue, while not quite at the peak they were, at a very healthy rate. And we also think retail sales will continue to operate at a very healthy rate. So all of that sets the background for consumption in the economy. And again, it's been a long time for some, including me, since I took my Principles of Economics class, but consumption is 70% of GDP in the United States. So this is the ability to consume, and that's 70% of GDP, very, very important background. Talked about business, and I'll just say very quickly, after having a couple of dismal years in 15 and 16, reflected by the negative numbers, we see the numbers in 17 and 18 quite positive. This, of course, is being driven by very good corporate profits in 17 and 18 is reflected in the left-hand graphic. So you have corporate profits going up, reflected in stronger business investment. And again, these forecasts are based on what we have right now. I wouldn't be surprised at all to see these revised upward in people's forecasts, including our own, if the corporate tax policy is passed. It could even be stronger. This could be very valuable, if you will, for the economy. The other piece in terms of having ability, it includes corporate profits, it includes low interest rate environment, but it also includes some sort of willingness. And these are confidence indexes done at the national level for manufacturing and for non-manufacturing. And again, these are at very healthy levels. Everything above 50 is expansionary, and you can see we're at very high levels in both manufacturing and in the non-manufacturing side. Not the euphoria that we had before the crash in the non-manufacturing side, but still very good numbers showing strong expansion in the economy. So all of this, I think, is really pointing towards, again, not only strong consumption in the economy, but strong business investment, which is very critical for competing now and in the future, and certainly critical when you have a tight workforce, that you're putting more and more into capital, and in the process of doing that, continuing to be able to expand the economy. Now, one piece of investment that we don't often think about is, we think of commercial buildings and industrial buildings, but residential is part of the overall investment picture as well. And of course, this leads into what we want to talk about in terms of Colorado, but you can see we're one of the fastest appreciating year over year in terms of Case-Shiller. I'll show you some other numbers here shortly, even stronger numbers. But this is specifically focused on the Denver area. It's considered a very reliable index, but it's, again, focused on a limited geographic area. When you look at the statewide numbers done by the National Federal Housing Finance Authority, yes, we are the darkest colored state on there. We have hovered between the fastest appreciation and the third fastest appreciation over the last several years. But we're looking at numbers over 10% for statewide federal housing finance appreciation of homes. So extremely hot housing market. And I own a home, so this is great news. Now, I think this is, we've been talking about this for 2 years. I think this is an Achilles heel for Colorado right now. It's hard to build entry-level housing in the state, and this is something that we're not building enough housing in the state right now. And this is something that continues to sort of worry us when we talk about Colorado. So normally over the long haul for the U.S. economy, 1.5 million housing units is long-term equilibrium. And you can see in terms of long-term equilibrium here, we're looking at still well below the long-term equilibrium. And let me go back to the previous slide for just a second. You will see that 0 is the lowest. So all of these states have positive housing price appreciation except Wyoming, our neighbors to the north. Everybody else has got positive housing price appreciation year over year. I guess West Virginia might be a little light there too. But the bottom line is we have housing price appreciation at fairly significant levels in many parts of the country right now. And this is really being driven by underproduction of housing at the national level. This is a tough slide to talk about, so I'm going to move on. If you put the long-term forecast slide on here, and this is not about the current budget debate, I mean not the current budget, but the current tax debate, the numbers get increasingly worse over time, really driven by demographics and more Medicaid and Medicare and Social Security payments on the outflow as the country ages. So it's a tough business, and it's one that's going to need a lot of attention at the federal level. So I don't want to talk about it. So exports, this is our net export position. We were suffering from a much stronger currency from 2011 all the way up to about end of 2016, beginning of 2017. We had strong run-up in the value of the dollar. It was great if we were traveling out of the country, but it was tough on our agricultural and our manufacturing sectors, including Colorado, our service sectors, types of things we export from Colorado. We've now seen an adjustment in the dollar. It's weakened quite a bit in the last 10, 11 months. We don't see it weakening much more, but we don't see it jumping back up in value either. The U.S. had sort of maintained a positive interest rate environment. Many parts of the world had gone to a negative interest rate environment, and now we're starting to see some of those other countries and other places starting to do a little bit more strengthening of their currency or raising of their interest rates, or at least stabilizing the liquidity situation. So that's going to help, strengthens their currencies, weakens the U.S. dollar, and we've sort of seen that in 2017. That would be a positive for exports, by the way, and that's what we're hoping for. We want to, our agricultural sector in Colorado very dependent on exports. Our manufacturing of high tech very dependent on exports. So we do have very important pieces that are related to the trade-weighted value of the dollar. And then closing on the sort of front end piece, interest rates. We're in a monetary environment that's certainly going to be showing, we believe, stronger interest rate increases. The trick here is that we're not seeing huge levels of inflation yet. So the Fed is doing this even though inflation has remained muted. But we expect to see a movement in the December meeting, and I expect to see 3 movements next year. So I think 100 more basis points on the short-term rate. Of course, every meeting, you're going to be looking at the current data. It's all open to sort of adjustments, but they're really looking to sort of normalize policy. In the process of doing that, you will likely see mortgage rate increases, but the highlight of this slide is not that the lines are all going up at the end, but that they're much lower than they were back in 2004, 2005, 2006, 2007, 2008. So we still are at very, very attractive mortgage rates, even with our forecast of 100 more basis points by the end of 19, if you will, as you go forward, 18 and into early 19. This is the Fed's balance sheet, and it's getting further over, but you can sort of see 2008, they had roughly $1 trillion of assets and liabilities on their balance sheet, and now the number is $4.5 trillion of assets and liabilities. And this has caused, it's not illegal, there's nothing illegal about what they did, but there are lots of people who believe that they shouldn't have a balance sheet of this size, and that they should really figure out how to shrink this back down and get their balance sheet back to a more normal position. The one particular piece that is somewhat unusual is that green, kind of mustardy or green piece, is mortgage-backed securities. So in 2008 and 2009, when the housing market just totally fell apart, the mortgage-backed securities part of the economy collapsed completely, and there was no mortgage-backed security market, and the Fed jumped in and started buying the mortgage-backed securities so that the housing market didn't collapse even worse than it did. So they jumped in, they were very active, they bought all these mortgage-backed securities, they continue to buy mortgage-backed securities, and that green band is something that a lot of people would like them to get out of that business and let that go back to the private sector where they believe it belongs. So right now there's been numerous requests from the Senate and Congress for the Federal Reserve to think very seriously about making their balance sheet leaner and cleaner. And leaner means squash it down and don't have as much. That's sort of obvious. Cleaner is get rid of the mortgage-backed securities. It's okay to hold treasuries. It's okay to hold other federal debt, but the mortgage-backed securities belong out in the banking sector. They don't belong on the balance sheet of the Federal Reserve. And again, I know a lot of people don't follow this, but just as a sort of basic statement, they can't hold IBM stock, and they can't hold Amazon debt. They can't hold Apple. They're not allowed to hold any of those things from the private sector. So the reason that there's some controversy is this is closer to a private sector instrument, mortgage-backed securities. So that's why there's people saying, you're really not supposed to be in that business. Get back to just holding government securities and get out of the mortgage-backed securities. Quick comment, because people are always interested in student loan debt. It is now the second largest piece, 10% of all debt. But as you can see, the big piece by far is mortgages at 67%, and then 4% for revolving HELOCs, home equity lines of credit. So 71% of the debt is being held basically held against real estate. Then you have auto loans at 9%, credit cards, student loans, and all other. If you looked at their payment records right now, for a period of time, all of them were getting better and less delinquent except student loans. Student loans have leveled off, and in the most recent data, we're starting to see higher delinquency rates on auto loans. So it's the one thing we're paying some attention to, and let me do a sub-paragraph on this. we're paying a lot of attention to debt. Everybody is, because this is what blew us up last time and we weren't watching closely. And so now we're watching all these different debt categories and failure rates, and is there anything out there that could sink the economy, and really cause something like 2008? The answer is no. If all the student debt was defaulted on, that would be sort of a relatively minor blip. It's not like 71% of your real estate market falling apart and all of those loans going underwater. So right now, at least, the debt situation looks okay, and the inflation situation remains very stable, around almost at the 2% mark. That's where the Fed would like it to be. Maybe they'd like it to even go up a little bit more to justify their continued movements in interest rates. So the summary there is slightly higher GDP rates. Consumer carried the economy for the past 5 years. Business investment is very promising. We don't think the exports will help much in terms of growth of the economy. Interest rates rising slowly, low inflation environment. That's the backdrop. What do we think about Colorado? Well, one of the things we've seen is population growth continuing to be very strong. Not quite as strong as it was a little bit earlier in the decade, but still running up in the sort of 90,000 range. And it may not be easy to see, but the bottom part is the natural increase, births versus deaths. And you can see that number has come down from 40,000 to, say, 36,000 at this point. So really part of the reason the population is growing more slowly is the relationship of new babies being born versus people dying. And it's really being focused on not as many babies being born, where our birth rates have gone down somewhat significantly. So we were the top 5 states for percentage growth and absolute growth. Now we're 7th and 8th in terms of population growth in the country. 84% of this growth is along the Front Range, and don't you know it, driving anywhere. You have to plan a lot more time than you did before, and again, going back to the infrastructure piece. And we continue to have strong net migration into the state, but as unemployment rates get so low around the country, there's just not a lot of that surplus labor hanging around out there that's going to be easy to continue to recruit. So we continue to be a little bit more concerned about how fast we can grow or how much employment we can grow when we just don't see a lot of available labor force at this point in time. What you will see when the numbers are done is that 2016 was, in fact, about 56,000 jobs, solid considering a 2.4% unemployment rate. We are going to be forecasting the 2017 number is a projection at this point. The 2018 number is going to be almost exactly the same, very, very close, and it's going to be a little under 2% employment growth in our new forecast that we're going to come out with in a couple of weeks. It's not because we think the economy is in bad shape. We think the economy is doing just fine. We just don't think there are a lot of there's not a lot of available labor, and there's no way that we can see that we're going to increase migration into the state past where we are right now. So it just is a constraint problem. As it stands right now, through October, with the official data, every sector in the state except manufacturing and mining has grown. The biggest one is professional and business services in green down on the bottom there. That it really relates to the high-tech jobs. Trade, transportation, and utilities is wholesale and retail trade, and of course the utilities. And then you can sort of see the others. When the data is revised, I know this will sound goofy, but when the data is revised, these are all going to be green. Manufacturing and mining are going to be positive as well. So it's really been balanced growth across all the different industry types in the state, and that's been very strong. Now, I know a lot of you are from counties that have agricultural base, and you don't see agriculture on here because the employment's measured in a different way, so it doesn't show up on these employment charts. Agriculture had an okay year, but not a good year. It's been 3 years in a row now of not very good agriculture. We're going to be forecasting a similar kind of year for 2018, and it really, this year cattle feeders came back from the ag people know this, so that was a good thing. but the crop prices have been very, very low. And so until we see a bigger jump up in crop prices, we don't see the ag sector really going through a strong recovery. And as many of you know, the counties that are heavily agricultural counties don't have a hugely diversified economy, many of them. So it's an extremely important sector, and they're a very reliant sector for those parts of the state. All of this picture is Colorado, top 10 state for 2017, and we think also 2018. We had been sort of a top 5 state, so we, quote, are slowing down in terms of our ranking. But again, this has a lot to do with us just not having available workforce, jobs going unfilled. We get huge reports of that on the surveys that we're doing, that people literally can't find people for the jobs that they have. And so year over year, and this, by the way, is not because these are areas I'm enamored with, but these are the metropolitan statistical areas, so the data is reported for the MSAs, and you can see that Colorado over year over year right now is 1.4. We think when it's adjusted, we'll end up around 2%. Unemployment rate in Colorado, 2.6% statewide, and places that that have more people unemployed, if you will, like Pueblo, you're still at 4%. I mean, it's incredibly tight labor market. It may be an advantage to some extent as companies are looking for areas to locate in the state, that they'll go to places that have a little bit more available workforce. Some of these places are just extremely tight. Fort Collins, Loveland, Boulder, Greeley, really, really tight labor force in the northern part of the state. When we look at what's happened since 2010, sort of the end of the recovery, you can sort of see how strong Colorado has been. The national number there in red, and then you can see the other metropolitan statistical areas. Greeley, clearly the strongest. Weld County had the incredible rapid rise up with energy, but also has agriculture and construction, and a lot more than just the energy. Had the drop off with energy prices, but has come back pretty strong. And as you can see, the strongest growth in the state. And then at the bottom, still positive growth, but not matching the national numbers. Grand Junction, Mesa County area, and then Pueblo. The state overall, you can see Colorado overall somewhat significantly higher than the national numbers, and this is what I was sort of alluding to earlier. So quick comments on natural resources and mining, because they're important to Colorado. We can see in terms of where things were, and especially 2008 when we had oil really booming, and then we went back and it was fine until 2014, and then you can see where we've been since in terms of oil prices, and maybe even more importantly for certain people in this room, clearly natural gas prices and the spot price of natural gas. And we had this great run up in the Western Slope, in particular 2008, early 2009, and then we had the dramatic drop off, and we continue to be at numbers that are really low in terms of overall natural gas prices. I took out the slide on coal. The prices aren't that bad, but the output, of course, has been going down somewhat significantly for various reasons. Continues to be a difficult situation. Regulation should make it more favorable, but we still need to find markets to sell the coal to. So that's sort of part of the issue that's out there. What's not necessarily well known is that Colorado, first line is telling you we're uber energy efficient as a state, but the rest of them are telling you how strong we are in terms of being an energy state. Total energy production 7th, crude 7th, natural gas 5th, coal 11th. We dropped out of the top 10. We were in the top 10. Solar 8th, wind 10th. So we're really overall a very, very, it's a hugely important sector to the state, and it's important to a lot of the more rural parts of the state, both the fossil fuel-based ones, but also the non-fossil fuel-based energy production is occurring in more rural parts of the state as well. Real estate and construction, I'm looking at my watch, I'm going to hit some of these. So this is just the supply and demand story I was trying to tell you earlier for the nation. This is the same thing for Colorado. So the red line is where we think housing production should be based on population growth and so on, and the blue is what we're actually producing. So all of the, clearly we overproduced prior to 2009, 2008, but since that point in time, we've been somewhat seriously underproducing, and that, of course, has led to some of the higher home prices that we're seeing. Year over year through the second quarter, Colorado, 10.4% housing price appreciation. And even, I shouldn't say even, my apologies to the Mesa County folks, but Grand Junction, the housing market has come back very nicely, not quite at 6%, but still housing prices are starting to come back pretty strong, even with somewhat tepid employment growth. You can see across the state over the last 10 years, the state has averaged 3.7% annually across the entire state for housing price appreciation. So again, it's great if you have a house, but if you're trying to get into a house or you're trying to recruit workers and housing is part of the picture, it does make Colorado expensive. It is clearly the most expensive market away from a coast in the country at this point. So that's what now we love it here, so we want to be here anyway. So residential, we are seeing some uptick in that, and again, we're seeing that back, but the number needs to get up to sort of the 40,000 number to really start to get back. And you can see nowhere near the kind of housing we were producing in the late 90s or early 2000s. So this would 40,000 would be a nice solid number. It wouldn't be one of these huge overproduction numbers, and really we think would really help the situation in terms of keeping housing prices from appreciating too much. And the total value of construction also quite strong, a little bit weaker in 17 than 16, but that piece, all of it combined, is at record levels, higher than it's ever been before. So the construction industry overall, when you include non-residential and infrastructure, non-building, we are at sort of record-setting levels at this point in time. And we think 17, when it closes, will be about the same as 16. It's lagging behind a little bit right now. So foreclosures, as far as we can tell, the lowest numbers ever in foreclosures in the state since they started keeping records. So you go across the state, that's not a solution, and that's obviously a reflection of even if someone loses their job and can't make their housing payments, the process of getting the house liquidated can happen much more easily, so it doesn't have to go through the foreclosure process, and clearly another reflection of how strong the housing market is. A couple of last comments, because I know I wanted to leave at least a minute or two. Retail trade sales continue strong in the state. You can see how steep the upward slope was in the blue on the left. On the right-hand side, 4.4%. We don't see this particularly slowing down. The state's income and the state's employment and all of those things and population growth all point to continued strong retail sales. One of the problems is, without getting into the details, the state computer crashed and a lot of the staff left, and the data is really fallen behind in terms of getting the retail data at the state level. So we're having to sort of estimate where we think things are. Not always the best way to do it, but hopefully they hired some great people, and I think they're on this. So hopefully we'll get caught up in the data in the not too distant future. General fund, you know that stuff. So let me flip to the end. Marijuana and hemp. Why? Because everybody wants to? No, I'm not going to talk about it. So last couple of slides so I can at least finish on time here. We do a confidence index. Our confidence index, although it has been coming down more recently, it was euphoric after the election. Our December survey that we released in January was extremely upbeat after the election. Now we have seen continuing sort of, I guess, statements of reality, much as we're seeing, all of us are seeing in Washington. It's not so easy to do some of the things we're trying to do, so that has brought down some of the optimism. I will say the business leaders are much less optimistic about the U.S. than they are about Colorado. They're really still gung-ho on Colorado, very worried about labor shortages, but other than that, they're just really positive about the Colorado and the Colorado environment. We also do something with the Secretary of State's office. We use their new entity filings to sort of model the economy. The new entity filings are really a reflection, we think, of the entrepreneurial side of the state economy. And you can see this is also forecasting continued growth in the economy based on the new entity filings going forward. So we feel really good about that. This is a lot of data, and it really continues to show growth in the state economy. So I wanted to conclude with this slide and put this in front of you. And by the way, the slides will all be available on the CCI website. So I'm giving them the slide deck, and you can look at the things that I didn't get a chance to really talk about. But if you look at this particular slide, it sort of tells the story of, what's going great and what's going good, and maybe what are things you're concerned about. And so this is how we ranked in the last year, the last 3 years, the last 5 years, and the last 10 years. And when you get a name like Rosie Rich, you've got to be careful to actually have numbers sometimes to sort of tell people, the reality statement, if you will. So the first one is the growth of state output, 14th in the country in the last year, but you can see the numbers have been strong. Employment growth, at least currently at 20, but we think we'll wind up better than that. Population growth, 7th. Personal income growth, 7th. Per capita personal income, 36. So that's telling you the personal income growth is being driven by the population growth, not necessarily by people making more money on an individualized basis. So that's one maybe small flag. Then dropping down, annual pay percentage growth, 35th in the country. So this is also an area of concern for us. You would think with 2.4% unemployment and everybody clamoring that they can't find workers and all of the stuff that's going on, that you would have average annual pay growth as a percentage a bigger number. So I don't know how much reading you've done on this or if this means anything to you, so let me sort of give you the thumbnail on this. There's two things happening. One thing is we're creating more below average wage jobs as a state. If you took middle of the, what's in the middle, we're creating about 65% of the jobs below the middle in terms of average wage. So that's dampening down average wage. They're paying a fair wage for that industry, tourism, but tourism on average is a lower wage industry. And we're hiring more people in tourism. We're hiring more people in health. This is the shocker to me from my report 3 years ago. When I just looked at the data for the first time, I should have known this like 20 years ago, but I looked at the data and health is a below average wage industry in Colorado. Well, why is that? Well, because we have a lot of people in social assistance jobs and other jobs that are not particularly high paying. I think of health and I think of doctors and registered nurses, and they're paid pretty well, right, in general. But that's not who dominates the health industry anymore. And it's going to be even more so over time with the new delivery models. There's going to be even more people in those other brackets. So anyway, annual pay, 10, so not bad. We're 10th on average, so that's not a bad number. Unemployment rate, 3. Labor force percentage growth, 1. That's great. People coming off the sidelines here, the participation rate is going up a little bit. The last one, look at the numbers across that line. 3rd in the last year, 1st highest state for appreciation in the last 3 years, 3rd highest for the last 5 years, last 10 years, the highest appreciating home prices over a 10-year period. So for me, that last one's a flag. Now I know we're out of time, and I know the governor will be coming, and I know you need your break, but I would take a question or two if there's anybody wants to ask a question. Yes, ma'am.
I was going to
Excuse me? Yeah, so tourism in general, this is where it falls, leisure and hospitality, has been very strong. Employment growth has been very strong. Occupancy rates have been strong, but we've added a lot of hotel space in certain parts of the state. So far, it seems to be on a trajectory to have another good year. Biggest issue there, as far as we can tell, is immigration and labor availability in those areas, and of course, housing costs dovetail with that too and have. But we think it's going to be another strong year for tourism. We get a lot of, as we've grown the Front Range, we're getting a lot more people internally recreating in Colorado from Colorado in addition to the outside. So, yeah. Okay, last question.
We've seen a trend nationally and in Colorado of box stores closing as a result of. My assumption is that e-commerce is beginning to take a huge bite out of those activities, which lessens funds for cities and in some cases counties that have taxes. What do you see in the future? I mean, we're in Denver and Aurora. We've added about 2 million square foot of warehouse space for fulfillment centers.
Right.
So can you address that?
Yes, so a little bit at least. So in terms of retail and shopping centers, Colorado is sort of fighting. The national numbers are horrible. Colorado's are not bad. We're seeing reconversion of a lot of those. I think they're all going into dispensaries, but no. We're seeing reconversion of a lot of shopping centers into a little bit smaller sizes. And we're also seeing companies like Amazon paying state tax now and ultimately paying municipality tax. So, Amazon, love them or hate them, but the fact that they're now actually doing the retail sales tax is hugely valuable for the communities. So that would be, if that didn't happen, that would be an enormous concern, just because cities and counties especially cities, are so dependent on retail sales. All right, I will be here for a few minutes. I know we're on break, and I need to get you to break. Right? Thank you.
All right. Thanks, Rich.
Thank you.